Yes, sir. Coming here with you guys on Chapter 5, Candlesticks and Patterns. I hope you guys enjoy the first 4 chapters. Why don't we go ahead and take a look at our course content. As you can see here, we are halfway through Chapter 5, and we're going to be talking about candlesticks. So, without further ado, let's get started. What is a candlestick? A candlestick is a type of price chart used that displays the high, low, open, and closing prices of a security or stock for a specific period, right? So let's take a look at our key takeaways. Key takeaway number 1. Candlesticks show that emotion by visually representing the size of price moves with different colors, right? So most likely the colors are going to be what? Green or red, right? Green meaning it's bullish or buyers, red meaning bearish or sellers, right? We'll talk about that as we go. But traders use the candlesticks to make trading decisions based on regularly occurring patterns that help forecast or predict the short-term direction of the price. Key takeaway number 2. Candlestick shows the market's open, the high, the low, and close price for the day. Now, the candlestick has a white part, which is called the real body, okay? All right, so let's go ahead and take a look at our next picture here. I want to show you guys a visualization of our candlesticks. We got the green candlesticks and the red. Like I said, this is the bullish green candlestick, right? This is the buying candlestick, right? The buyers, and then the sellers, the red bearish candlesticks. As you can see here, we got the high. This is called the upper shadow, or you may have heard of wicks. So it's either going to be called the upper shadow or upper wicks. In this case, we'll just call it upper shadows. You can see here the top of the body is going to be called the closed. Top of the body of this here is going to be open, right? And then the bottom of the bullish candlestick is going to be considered the open, and the bottom of the bearish candlestick is going to be considered the closed. Now here, the full body is going to be called the real body. Okay, this is the real body, the upper shadows, and then these are the lower shadows, the lows. Okay, so make sure you guys understand that. All right, other than that, let's go and take a look at our basic candlestick patterns. Now, candlesticks are created by the up and down movements in the price. Now, while these price movements sometimes appear random, at other times, they form patterns that traders use for analysis or trading purposes. So now there are many candlestick patterns, but we're going to be basically here on our Chapter 5, since this is a beginner course, we're going to be talking about the most widely used and well-known basic candlestick patterns. There are a lot, but as you guys just know these things, then you guys are going to be just fine. Now, patterns are separated into bullish and bearish, like we talked about. Now, and bullish patterns indicate that the price is likely to do what? It's going to be likely to rise. And while bearish patterns indicate that the price is likely to fall. No pattern works all the time, guys. So, as candlesticks pattern represents tendencies and price movements, there are no guarantees, okay? So you guys always keep in mind, in the stock market, there are no such thing as guarantees. Take that dictionary or word out of your dictionary, all right? Now, we got the engulfing candlestick pattern here, okay? I want to talk about. So first things first, in this picture, this is considered a bearish engulfing pattern. What is this? So first things first, a bearish engulfing pattern develops in an uptrend when sellers outnumber buyers. Okay, so as you can see here, we got the bullish candlesticks forming nice higher lows, right? Meaning the lows are becoming higher, right? And the highs are becoming higher, meaning this is a bullish movement. So if we had to draw a trend line, it is moving on uptrend, it's bullish, it's healthy, until what happens, guys? We see a bearish engulfing candlestick or pattern, right? This is when the action is reflected by a long red real body engulfing a small, this previous green real body, right? So the pattern is basically indicating that sellers are back in control and that the price could continue to decline, right? No guarantees, could decline. So it's a chance or a probability, that's a good high probability when you see a red bearish engulfing pattern, right? That is twice larger than the previous green body, right? That means is what? You're probably going to see a change of pattern or trend. Like if it was uptrending, then you better bet that the stock is going to start what? Probably coming on down. Now, this is the opposite. This is called the bullish engulfing pattern. An engulfing pattern on the bullish side of the market takes place when buyers outpace sellers. So as you can see here, this is the opposite, where let's say the stock or the candlesticks are on a downtrend, or they are making lower lows, lower highs. They're basically, climbing down the stairs, meaning it's a poor, unhealthy movement until what happens? You see that reversal of this bullish engulfing pattern where the real body right, engulfs over by half or more of this previous red body. Okay, so when you see a large bullish engulfing pattern or this candlesticks, basically taking over this previous red real body, you better bet or predict that the stock is going to what? There's a change in pattern, or the stock is coming to a what? A change of an uptrend coming potentially. So this is reflected in the chart. You can see by this long green real body engulfing a small red real body. And so that means what? With bulls having established some control, now you can see that potentially the price could head higher. Okay, so very useful candlestick patterns that you guys should know. Okay, now the next stock, or not next stock, the next chart candlestick pattern here is what we call the doji star candlestick pattern. Okay, now a doji is a name for a session in which the candlestick for a security has an open and close that are virtually equal and are often components and patterns. Okay, so the doji candlesticks, guys, as you can see here, this is this doji candlestick right here, as the arrow shows. It shows like a what? First thing first, it looks like a cross, or perhaps it looks like a plus sign to you, right? Alone, these dojis are considered neutral patterns that are, also featured in a number of important patterns. But a doji candlestick forms when its security or the stocks open and close are virtually equal for the given time period and generally signals a reversal pattern. So basically, when you guys see, let's say a stock is downtrending, there is multiple red candles coming down, meaning it's unhealthy, the price is coming down, and then you see a doji like a cross sign or this plus signal, right, with no real body, it's virtually equal, right? What does that mean? It's indicating that perhaps a reversal of downtrend is coming. What's the reversal of downtrend? An uptrend, right? So now you can see here, it may not be immediate, it may take another candlestick or two, but eventually what? There's a high chance that the stock does move back on up or reverse from whatever it was. Same is the same case here. If there was resistance, the stock has been having multiple, failures, breaking the resistance, and you can see after a doji, there's a big fat bullish candlestick, right? A bullish candlestick that is breaking the indicator, or not the indicator, the resistance that is indicating that a reversal is coming, which in this case, now that it broke resistance, price or the candlesticks move up higher. Okay, now the next thing that I want you guys to definitely know is called the hammer candlestick pattern. Everything that we're talking about right here, right now, is something that you all should know. Okay, now the hammer is a price pattern in candlestick charting that occurs when a security trades significantly lower than its opening, but it rallies within the period to close near opening price. Okay, so as you can see here, it's very simple. It looks literally like a hammer. You see a tiny little real body, and then you don't hardly see a upper shadow or upper wick. You will see a long wick or long, lower shadow, meaning it literally is going to look like a hammer, right? You got a nice little looking hammer candlestick. So what this pattern means is that when this pattern forms, guys, a hammer-shaped candlestick, right? This is indicating that there's going to be it's representing a difference, right, between the open and closing prices, while the shadow shows the high and low prices for the period. So what, in simple terms, when you see a hammer, that means that there's a bullish movement coming in. Does that make sense? When you see, after some multiple red candlesticks, you see the stock price coming down, but on the candlestick or the chart, you see that hammer, you better bet, or there's a high prediction, right, or probability, that the stock price or the candlesticks are going to move back on up. So this is a good sign. Hammer is good, okay? So you want to look for these hammer candlesticks. Now, the opposite is true. This is called the shooting star candlestick pattern, or what we also call the inverse hammer, okay? You can see here that the hammer has been inversed, so you can either call it the inverse hammer pattern or what? The shooting star. Right, it looks like a shooting star. So a shooting star is a bearish candlestick. Remember, the hammer was bullish. This is at the opposite. So this is a bearish candlestick with a long upper shadow, right? You can see this long upper shadow. It's basically the opposite from the hammer. Little or no lower shadow, right? There's no lower shadows. And a small real body. Same thing, near the low of the day, but it's going to be red because it's bearish. So it appears after an uptrend, okay? A shooting star will only appear after the stock has been moving on up, which is a good indicator that what? You should probably look to sell after you see a inverse hammer or this shooting star, correct? So the shooting star is a type of candlestick that forms when a security stock opens And then, at the opening, you see those stocks that just runs on up, right? It advances significantly, but after seeing a shooting star or inverse hammer, you have a good chance that the stock price is going to be what? Coming down and down, and eventually hitting back down to the opening price again. Okay, so for a candlestick to be considered a shooting star, the formation must appear during a price advance. Now, also keep in mind the distance between the highest price of the day and the opening price must be what? It must be more than twice as large as a shooting star's body. Okay, and there should be little to no shadow below the real body. Okay. I think this is pretty straightforward. Now, other than that, let's go ahead and talk about the next candlestick pattern. It's called the double bottom, and we also have the double top. Let's start with double bottom here example. So a double bottom is what? Is an extremely bullish technical reversal pattern that forms after an asset reaches or stock reaches a lower price two consecutive times. So as you can see here, this picture example, I got you guys this example of double bottom. Basically, when you see the lower shadows or lower wicks forming or hitting twice at a support or a floor level, let's say, this is considered a double bottom, meaning a bullish movement is coming. After you see these candlesticks, forming twice at a certain level, that means what? You're gonna expect the buyers coming in, and then you see bullish green candlesticks, which is gonna lead the stock price higher and higher. So this is a good sign. You want to look for these double bottoms. Sometimes you will see double bottom as the bottom of the candlesticks, but most of the time, okay, bottom of the body candlesticks, most of the time it's gonna be the lower shadows. So anytime you see double bottom, anytime you see a double bottom here on the lower wicks or the lower bottoms, but in this case, example is the lower shadow, okay? Now, the double top example is the opposite. Basically, a double top is an extremely bearish technical reversal pattern that forms after an asset or stock reaches a high price two consecutive times, right? So you can see here, as the stock price is uptrending, as it goes on up, you find this double top, meaning, what does this mean? This is a resistance, right? So stock price or the candlesticks somehow cannot be able to break through this area. And when you see these upper wicks or upper shadows are hitting this area twice, that means what? It's a change of reversal, or it's coming down to a downtrend. So when you see a double top, it's a hint or a potential signal, letting you know that, what? Maybe the stock price is about to come down. So when traders are in the middle of a trade and they see the double top, what are they going to do? They're going to go ahead and look to take their profits, cut their losses, or wherever they got in, they're going to just go ahead and sell. And as the selling happens, the stock price comes down. So it's an indicator to go ahead, maybe it's time for the stock to come down. So why don't we go ahead and take the profits here or sell it here, okay? Now, the next stock, or the next candlestick pattern is the triple bottom and the triple top candlestick pattern, okay? So let's talk about this triple bottom example. So a triple bottom is an extremely bullish technical reversal pattern that forms after an asset or stock reaches a lower price 3 consecutive times. So it's basically like the double bottom, but you see the third candlestick lower shadow touching it the third time on the same place, right? So when you see a stock coming down, but it's holding, right, and it tests there again, holding, test there is holding, that is a sign that, this is a very strong support. This means that, the buyers want to come back in and there's no more sellers as much. So when there's less sellers and there's more buyers, what happens to the price or the candlesticks? They will move up, right? And as you can see here, after hitting a triple bottom, the candlesticks are forming what? Nice higher lows again, and they are on its way back on up. Okay, again, no guarantees, just keep that in mind. It's a probability game in this trading game, okay, in the stock market. Now, the opposite is true, triple top. This is a very, very extremely bearish technical reversal pattern that forms after an asset or stock reaches a price or high price, right? 3 consecutive times. So a high price hitting 3 consecutive times means what? It's a triple top, meaning there is a big, big fat resistance there. And the stock price just can't seem to pierce through that level. Meaning what? If that certain level of price can't seem to go any higher, the stock price is going to come down because the buyers that have been holding are going to see what's going on. I guess this is the peak, time to sell. And when people sell, what happens to the price? It goes down, right? As more and more people start seeing more sellers, other people follow. It's like a snowball effect, and then the stock comes down pretty bad. So, when you see an uptrend and head test 3 times, that's called a triple top. When you see that during the middle of a trade, okay, please do your best to just go ahead and exit your positions. There's a high chance that the stock price is going to be hitting the high. That's going to be considered the high, and it's going to be coming down. Does that make sense, guys? I hope this really helped. We really just wanted to cover the very basics of the top used, widely known, candlestick patterns. And if you guys can put this into your trading every single day and look out for these, I promise you your trading game will be increasing and you will see profits. So thank you all so much.